Good evening, guys. A very good evening, everybody. Please give me a quick confirmation. Is the audio video all clear? Shall we begin? Waiting for your responses. All clear? All right. Let's begin. So, as you all know, in this lecture, we will be solving the mock test paper. Now, ICAI has brought in two mock test papers for the May 2021 exams, which of course are postponed to July. Now, in today's video, we will be discussing about the March 2021 question paper. Not just discussing, we are actually going to solve it. So I hope you have the mock test paper, your notebook, your stationery, your calculator all ready with you. All right. So shall we begin? Yes, we'll start with the MCQs and then we'll go to the descriptive questions. Very good questions have been put up into the MTP this time by ICAI. Some questions are very challenging. Some questions haven't been seen ever before in the examination or in the study material. There are some new questions also. So it will be a very, very good revision for all of us. Make sure you make full use of the chat box. All right. Keep sending me your responses in the chat box. Keep working out along with me. Now, this lecture is going to be as effective as I want it to be only if you actually solve along with me. Just watching, just listening, no, that is not how we want to do it. We are supposed to keep our pen, our paper, our mock test question paper, our calculator with us, and please work out along with me. Okay, so without wasting any more time, let me begin. Let's start with the very first question. We'll do the MCQs first, like how I just told you. This is the first MCQ. Here, like how I told you already, there are two mock test papers for your attempt uploaded by ICAI on the website. I am solving the March 2021 mock test paper right now. All right, the income tax part. Now look at the first question. Let's read through the question. Let us see what exactly they have asked us to do in the question. Let's give it a reading. Mr. Ram, an Indian resident, purchased a residential house property at Gwalior on 28 May 1999 for 28.5 lakhs. The FMV and the stamp duty value of such house property on 1st April 2001 was 33.5 lakhs and 32.4 lakhs respectively. On 5th February 2012, Mr. Ram entered into an agreement with Mr. Mcqs for sale of such property for rupees 74 lakhs and received an amount of rupees 3.9 lakhs as advance. However, as Mr. Mcqs did not pay the balance amount, Mr. Ram forfeited the advance. On 15th April 2020, Mr. Ram sold the house property for 2.1 crores when the stamp duty value of the property was 2.33 crores. Further, he purchased two residential house properties at Delhi and Mumbai for 54 lakhs each on 28 August 2020. On 28 February 2021, Mr. Ram decided to sell the house property at Mumbai to his nephew, Mr. Vaibhav, for rupees 58 lakhs, from whom 19,000 was received in cash on 15th Jan 2021 as advance for signing the agreement to sale. Sale deed was registered on 30th March 2021 on receipt of the balance amount through account payee check from Mr. Vaibhav. Stamp duty value of house property at Mumbai on 28 February 2021 and 30th March 2021 was 61 lakhs and 64 lakhs respectively. They have given us the cost inflation index. Based on the above information, choose the appropriate option. All right. Now look at the first, before we go to the first question, let us discuss what exactly has happened over here. So my assessee, Mr. Ram, he had a house at Gwalior. He sold this house to his he sold this house for 2.1 crore, and he purchased two houses. He sold a house property, he purchased a house property. So when you sell houses and you buy houses, section 54 exemption gets attracted, right? And then there is one more transaction over here. He had sold a house and he had purchased two houses. Out of the two houses he's purchased, one of them he wants to sell off now. Now, do you remember in section 54, what is a lock-in period? We have a lock-in period of how many years? We're supposed to keep the new house with us for how many years? Lock-in period is 3 years, right? Even before the expiry of 3 years, he's selling away the house. So, we are supposed to reduce the cost of acquisition by the exemption which is already enjoyed, right? So, this is a question which focuses on section 54, and it also talks about advance money. My assessee had forfeited advance money. Now, what are you going to do with this advance money forfeited? I'm going to give you two options. Are you going to tax this as IFOS in the previous year of forfeiture, or are you going to reduce it from cost of acquisition subsequently whenever we sell the property? What are you going to do out of the two options? Option 1 or option 2? Option 1, will you tax it as IFOS in the year of forfeiture? Or option 2, will you reduce it from cost of acquisition in the year of transfer? Here definitely option 2, right? Why? Because my assessee has forfeited the advance before 1st April 2014. Right? So when the advance is forfeited before 1st April 2014, we reduce the forfeited advance from the cost of acquisition in the year of transfer. Only if the advance is forfeited on or after 1st April 2014, only then we tax the advance money forfeited as IFOS in the year of forfeiture. Here option 2. All right. So with this, let's begin. Let's begin the first subdivision over here. They're asking us to find the indexed cost of acquisition of the residential house property at Gwalior for computation of capital gains in the hands of Mr. Ram. All right. So we're supposed to find the cost of acquisition of the Gwalior house property. All right. Now, how will we find the cost of acquisition? When was this property purchased? This property was purchased by Mr. Ram on 28th May 1999. When a property is purchased on 20th May 1999, which is before 1st April 2001, so what do? You compare the actual cost of acquisition with the FMV on 1st April 2001 and you pick whichever is higher. But then immovable property, we're talking about immovable property. A very recent amendment to Income Tax Act says when an immovable property was purchased before 1st April 2001, later when you transfer this immovable property, you will compare the actual cost of acquisition with what? FMV or SDV on 1st April 2001, whichever is lower. Let me show you how exactly this is supposed to be done. Now here, one moment. Yeah. So look at my discussion. Now the solutions which I'm going to give you, I know that these are MCQ questions, but still I'm going to show you the solution with proper presentation because these questions could have also been asked, as a descriptive question. So we are supposed to know about proper presentation. MCQ questions, fine, presentation not required in the examination. But what if this question, something similar to this comes in the examination as a descriptive question? We should know how to present the answer. So keeping that in mind, the solutions that I'm going to show you will be not just solving, we'll also do with proper presentation. As in, this is how we're supposed to do in the examination, had it been a descriptive question instead of an MCQ. Okay, so we are handling question number 1 right now and subdivision 1 of this. All right, so here, what is a capital asset that we are talking about? We are talking about the Gwalior house. Okay, and this capital asset was acquired when it was acquired before 1st April 2001. Whenever you acquire a property before 1st April 2001, what is the cost of acquisition? You take the actual cost of acquisition. How much did my assessee actually incur for the house? he has actually incurred 28,50,000, right? Mr. Ram, an Indian resident, purchased a residential house property for 28,50,000. So his actual cost of acquisition is 28,50,000. All right. You compare this with, earlier we would just compare this with FMV as on 1st April 2001. But as per the Finance Act 2020 amendment, for immovable property, not just FMV, we also have to consider the SDV on 1st April 2001, right? So what is our FMV on 1st April 2001? FMV on 1st April 2001 was 33,50,000. And what is SDV on 1st April 2001? 32,40,000. Out of these two numbers, we are supposed to pick whichever is lesser. And which is lesser in my question? Definitely SDV 32,40,000. Okay, now out of these two numbers, we are supposed to pick whichever is higher. Actual cost of acquisition or lower of these two, whichever is higher. Which is higher? 32,40,000. So my cost of acquisition is 32,40,000. Is this clear for everybody? Yes. So my actual cost of acquisition is 28,50,000. I'll compare this with FMV on 1st April 2001, SDV on 1st April 2001. Out of these two, I will pick whichever is lesser, which is 32,40,000. And out of actual cost of acquisition and 32,40,000, I'll pick whichever is higher. So 32,40,000 becomes a cost of acquisition. Now, in the question, they have asked us to find the indexed cost of acquisition. All right. But before we do indexation, do you remember we saw that my assessee has also forfeited some advance money, right? So what to do about the advance money forfeited? We discussed that the advance money was forfeited when? It was forfeited before 1st April 2014. So what are we going to do with this advance money? We will reduce this advance money from the actual cost of acquisition. So what is my cost of acquisition? We just computed 32,40,000. So from this number, we will reduce the advance money forfeited. So any advance money forfeited before 1st April 2014 to be reduced from cost of acquisition. So what is our cost of acquisition? 32,40,000. What is the advance money which we forfeited? He received an amount of 3,90,000 as advance, which was forfeited. So this 3,90,000 advance money forfeited, I will reduce it from my cost of acquisition. So what will be the cost of acquisition that we are left with? 32,40,000 minus 3,90,000. We will be left with 28,50,000. This is the number that we will index. Are we clear until here? Yes. So this is the number we are going to index. Now, what is the indexed cost of acquisition? How to compute? Cost of acquisition into CII of the year of transfer divided by CII of the year of acquisition. So our cost of acquisition is 28,50,000. Now, what is our previous year of transfer? When are we selling the property? On 15th April 2020, Mr. Ram sold the property. So what is the year of transfer? My year of transfer will be previous year, 2021. So for 2021, what is our index number? 301. So CII of year of transfer 301 by CII of the year of acquisition. The property was acquired before 1st April 2001. Whenever a property is acquired before 1st April 2001, our CII will be the CII of the year 2001 to, which is 100. All right. So do your math. Tell me what would your answer be? Do you get 85,78,500? Yes. Do we get this number, everybody? So this is what your answer would be. 85,78,500. Here, the steps involved were, because my property was purchased before 1st April 2001, we had to do all these comparisons over here. Then we had to remember to subtract advance money forfeited and then our normal usual indexation. So your answer will be 85,78,500. 85,78,500 is which option? Here, option number C. Are we all done writing? Yes? Simple discussion. If you knew all the concepts, it would have been pretty easy. Then what else are they asking us? They're also asking us the amount of capital gains taxable for assessment year 21-22 in the hands of Mr. Ram for sale of residential house property at Gwalior. So right now what we did was we just computed the cost of acquisition, the indexed cost of acquisition. And now they're also asking us to compute the capital gains. All right. So come on, let's get to work. Answer to subdivision 2, we have to find capital gains. How do we find capital gains? We generally start with the full value consideration, right? Now, what is the full value consideration? For what price, for what amount is he selling the property? Mr. Ram sold the house property for 2 crore 10 lakhs, 2.10 crores, when the stamp duty value was 2.33 crores. So they have given us the actual consideration and they have also mentioned what is the SDV. So now, does any section strike your mind? Does any section strike your mind? They have given us the actual full value consideration and they've also given us the stamp duty value. So obviously, which section are we talking about? Which section are we supposed to apply? Obviously, section 50C, right? So for full value consideration, we'll have to apply section 50C, which roughly I'll show the calculation over here. So how do I do the calculation for section 50C? What do I start with? I'll start with 110% of FVC, right? So what is my FVC? Our actual FVC is 2.10 crore. So 2.1 crore into 110%, this will be 2.31 crores, right? 2.1 is my actual FVC, 110% of this 2.31 crore. I'll compare the SDV with 110% of FVC. What is our SDV? Our SDV is 2.33 crores. So if SDV is more than 110% of FVC, only then section 50C will be applicable. And in this question, certainly SDV is more than 110% of FVC. Definitely. Therefore, section 50C will apply. As per section 50C, I will ignore my actual FVC. I will consider the SDV number only as my FVC hereafter. Right? Simple discussion, usual discussion. So here my SDV was more than 110% of FVC. So I will ignore the actual FVC and I will assume the SDV number to be the FVC hereafter for all calculation purposes. So even though my actual full value consideration is 2.1 crore, I will take the SDV number of 2.33 crores as my full value consideration. This is applying section 50C. From this, we will subtract our expenses on transfer. Do we have any expenses on transfer? No, we don't. So what is our net consideration? The same number, 2 crore 33 lakh. This remains to be a net consideration. From this, we will subtract index cost of acquisition, which we have already computed for subdivision 1. Index cost of acquisition was 85 lakhs, 78,500. From this, we subtract our index cost of improvement. We don't have any cost of improvement in this question. So what is the LTC? Why LTCG? Why indexation? Because see, we purchased the property on 28 made 1999 and we are selling it on 15th April 2020. The period of holding is 28th May 99 to 15th April 2020. Definitely more than, you tell me, what is the relevant period of holding for immovable property? Is it 12 months? Is it 24 months? Or is it 36 months? 12, 24, 36, what are you going to apply? What will your relevant period of holding be for immovable property? 24 months, right? And this is definitely more than 24 months. Hence, it becomes a long-term capital asset. Because long-term capital asset, we are doing indexation and all. All right. So coming back to my answer now, long-term capital gain, how much do we get? 2 crore 33 lakhs minus 85 lakh 78,500. You will get 1 crore 47 lakhs 21,500. Right? Now from this, we will subtract section 54 exemption. Now why section 54 exemption? See, my assess. What does section 54 say? Section 54 says, first of all, the assessee should be an individual or HUF. Yes, my assessee is an individual. He should have sold a house property. Yes, he sold a house property. This should be a long-term capital asset. We've already spoken. Period of holding is more than 24 months. Therefore, it is definitely a long-term capital asset. Then section 54F says you should have sold a residential house property and you should have purchased another residential house property. It says purchase one residential house property in India. Here my assessee has purchased 2 residential house properties and both he has purchased in India, one in Delhi, one in Mumbai. The section also says that if you're purchasing, you must purchase either 1 year before transfer or you must purchase within 2 years after transfer. Here, what is the date of transfer? 15th April 2020. And we are purchasing 2 houses in India on 28th August 2020, which means definitely we are purchasing the 2 houses within 2 years from the date of transfer. But then, like how I just told you, section 54 requires that you should purchase only 1 residential house property in India. But in this question, we have purchased 2 residential houses, one in Delhi, one in Mumbai. What to do now? See, listen. Finance Act 2020 had made another amendment to section 54. Finance Act 2020 said, yes, agreed, the exemption is only purchase of 1 residential house property in India. But then section 54, the amended section 54 says, once in the lifetime of the assessee, he can get exemption for 2 residential house properties in India, but only once in his lifetime. And the precondition is that LTCG should not be more than 2 crores. Let's assume never in his life he has taken the exemption of 2 houses together. LTCG is not more than 2 crores. Conditions are fulfilled. So we will take exemption for both the houses. Is this clear? Yes, agreed. Section 54 says you get exemption of only 1 residential house property in India. But the latest amendment made by Finance Act 2020, it says that in case you purchase 2 residential house properties in India, it is okay. Once in your lifetime, you can avail the exemption of both the houses. You can avail the exemption of 2 residential house properties in India. Precondition, LTCG should not be more than 2 crores. All those conditions get fulfilled. So we will enjoy the exemption for both the houses in this question. We'll assume never in his life he has enjoyed this 2 times, this 2 houses exemption. And the LTCG is only 1 crore 47 lakh. The LTCG is not more than 2 crores. So we will give the 54 exemption for both the houses. He purchased 2 houses for 54 lakhs each. So the 54 exemption will be 54 lakhs for 2 houses. How much will that be? 1 crore and 8 lakhs. Right? So what will our taxable LTCG be? taxable LTCG is going to be 39,21,500. Okay. Are you seeing the kind of questions? Very good questions have been asked in the MTP. A lot of questions over here focus on amendments. Very good questions are there. If you have thoroughly learned the concepts, the mock test paper is a very good place for you to check, to assess whether you've understood the concepts properly or not. Are we all done with this? Any questions? Please get the questions clarified. If no questions, we are good to go. All right. Hoping you are all done writing. So our taxable LTCG is 39,21,500. Which option would that be? Here, option A. Right? I'll wait for a minute. In case anybody is still writing, please finish writing and then we will proceed. All right. Let's go to the next subdivision now. The third subdivision over here. They're asking us to compute the amount of capital gains taxable for assessment year 21-22 in the hands of Mr. Ram for sale of residential house property at Mumbai. Now, do you remember the question? He had sold the Gwalior property and he had purchased two houses, Delhi and Mumbai, for which he had claimed 54 exemption. This Mumbai house he later sold off. He had purchased this Mumbai house on 28th August 2020. When you purchase a house and you get section 54 exemption, you are supposed to retain that house for the lock-in period of 3 years. But without waiting for 3 years to expire, on 28th February 2021 itself, he sold away the Mumbai house to his nephew, Mr. Weber, for 58 lakhs, from whom 19,000 rupees was received in cash on 15th Jan 2021 as advance for signing the agreement to sale. Sale deed was registered on 30th March 2021 on receipt of the balance amount through account paid check. SDV, they've given us SDV on 2 dates. What is 28th February 2021? This is the date of agreement. The date of agreement between my assessee and Mr. Weber. And what is 30th March 2021? This is the date of registration, the date on which the sale deed was registered. They've given us 2 SDVs. And what are they asking us to compute? The capital gains for this Mumbai house. So let's begin. In your notebooks, we'll work out the answer to subdivision 3. Again, we have to compute capital gains, but this time we are computing capital gains for which house? We are computing capital gains for the Mumbai house. Now, what is the period of holding of this Mumbai house? When did we acquire this house? This house was acquired on 28th August 2020. And when are we transferring this house? On 28th February 2021. Now tell me, what do you think about the period of holding? Because of the period of holding, is it going to be a long-term capital asset or is it a short-term capital asset? See, again, in this calculation, my capital asset is an immovable property. Now, because my capital asset is an immovable property, what will the relevant period of holding be? 12, 24 or 36 months? What will the relevant period of holding be? It's going to be 24 months, and this is definitely less than 24 months. Therefore, what kind of an asset is our property over here? It is certainly a short-term capital asset. Okay, so let's do the calculation. We will start with the full value consideration. Now, what is the full value consideration? At what amount was the property sold? The property was sold for 58 lakh rupees. All right. But then they've also given us SDV. So again, which section strikes your mind? Immovable property SDV is given. Obviously, section 50C will strike your mind. 50C says, see what is 110% of FVC. So here we'll have to apply section 50C. I'm applying section 50C here itself roughly. So what is 110% of our FVC? Our FVC, our actual full value consideration is 58 lakhs. So 58 lakhs into 110%, you will get 63 lakh and 80,000. We'll compare SDV with this number. But then problem, we have two SDVs over here. Which SDV, which of the two SDVs are we going to pick? What would your answer be? Simple. When they give us SDV on the date of agreement and SDV on the date of registration, you are allowed to pick SDV on date of agreement only if at least some consideration is received by the transferor on or before the date of agreement. How? In what mode? In at least one of the specified modes. What are the specified modes? Account payee check, account payee bank draft, ECS, any other electronic mode. Understand? When we have two SDVs, when do we pick SDV as on the date of agreement? We pick SDV on the date of agreement only if at least some consideration is received by the transferor on or before the date of agreement by one of the specified modes. Now over here in this question, my assessee, Mr. Ram, he has received some consideration. He did receive 19,000. On or before the date of agreement, he did receive some consideration. But then, did he receive that some consideration in specified mode? No. He has received it in cash. So this condition is not fulfilled. So because one of these three conditions is not fulfilled, I cannot take SDV on date of agreement. So instead, tell me, I am going to pick SDV on which date? I will instead obviously pick SDV on the date of registration. Are we all clear with this? Yes, we did receive some consideration, 19,000. We did receive it on or before date of agreement. Date of agreement is only 28 February 2021. Before that, on 15th January itself, we received some consideration. But it was not in specified mode, it was in cash. And hence, we cannot pick SDV on date of agreement. We'll have to pick SDV on date of registration, which is 64 lakhs. So SDV 64 lakhs. Now this SDV is more than 110% of FVC. So which means section 50C gets thoroughly attracted. Now as per section 50C, I will ignore the actual full value consideration. I will consider the SDV as my FVC for all calculation purposes. Because SDV is more than 110% of FVC, we will ignore the actual FVC now. We will assume our SDV number only is FVC for all calculation purposes. So what is the full value consideration that we will write over here? 64 lakhs. Right? From this, what do we subtract? Expenses on transfer. Do we have any expenses on transfer? No. So this entire 64 lakhs becomes our net consideration. Right? From this, we subtract our cost of acquisition. We don't subtract index cost of acquisition. No indexation because short-term capital asset. So what will the cost of acquisition be? My actual cost of acquisition is how much? What did we actually incur to purchase this property, to purchase this Mumbai house? What did we actually incur? We actually incurred 54 lakhs, right? For each of the two houses, we had incurred 54 lakhs. But then section 54 is getting violated. Why? Because we are selling, because we enjoyed section 54 exemption, and then we are selling away the property in less than 3 years. right? We are selling it before the expiry of lock-in period. So here there is certainly a violation of section 54. And when there is a violation of section 54 lock-in period, what do? From the cost of acquisition, you subtract the exemption which was already enjoyed. For Mumbai house, how much exemption did you enjoy? The entire 54 lakhs you had enjoyed, isn't it? See here, our exemption was 1 crore 8 lakhs. How did we get this 1 crore 8 lakhs? We considered 54 lakh of Delhi house, 54 lakh of Mumbai house. So the entire 54 lakhs we have considered as exemption. So from the cost of acquisition, I will reduce the exemption we enjoyed, the entire 54 lakhs. Why am I reducing this? Because we sold the Mumbai house even before the expiry of 3 years lock-in period. So what will my cost of acquisition be? 0. We don't have any cost of improvement. So what is the STCG that we will be left with? Our STCG is going to be 64 lakh rupees. Are we all clear with this? Yes. So our answer will be 64 lakh rupees STCG. Now here our answer will be option D. I'll wait for a minute. In case anybody is still writing, please finish off the solution and then we will proceed to the next subdivision. All right. I hope all of you are done. Can we go to the next subdivision? Look at this, subdivision 4. They're asking us, what is the amount taxable under section 56(2)(10) in the hands of Mr. Vaibhav, if any? What is the amount taxable under section 56(2)(10)? So first of all, what is this section 56 subsection 2 clause 10? What does the section talk about? It's nothing but your IFOS, your gift section. The section which says cash gift more than 50,000 taxable, immovable property gift, SDV more than 50,000 taxable. The section which taxes gift for you all under IFOS, that is section 56(2)(10). So they're asking us to compute what will be Mr. Vaibhav's taxable gift. All right. One moment, I closed the file by mistake. One moment. Yeah. So look at this. We have to find what is his gift, a total taxable gift. Now, what is Vaibhav receiving because of which they're talking about gift and all? Mr. Ram is selling his house property to Mr. Vaibhav for 58 lakhs, whereas the SDV is 64 lakhs. So don't you think over here, there is immovable property received by Mr. Vaibhav for inadequate consideration, right? And Mr. Vaibhav is receiving this from whom? He is receiving this from Mr. Ram. What is the relationship between Mr. Ram and Mr. Vaibhav? They are saying that Mr. Vaibhav is Mr. Ram's nephew. Mr. Ram decided to sell the house property at Mumbai to his nephew, Mr. Vaibhav, for 58 lakhs. So Mr. Vaibhav and Mr. Ram, they are related to each other. Mr. Ram's nephew is Mr. Vaibhav. Ram has given an immovable property to Mr. Vaibhav for inadequate consideration. So the gift over here is the Mumbai house given for inadequate consideration. The gift is immovable property received for inadequate consideration. But Mr. Vaibhav is receiving this gift from whom? From his uncle. And we all know that section 56, subsection 2, clause 10, yes, immovable property received for inadequate consideration is certainly taxable. But then we also have some exemptions. Whenever my assessee receives any gift from a relative, it is exempt. And what do you mean by a relative? If I am the assessee, then my children, my grandchildren, my great-grandchildren, and so on, my parents, my grandparents, my great-grandparents, and so on, my brother, my sister, my parents, brothers and sisters, my spouse's children, grandchildren, great-grandchildren, and so on, my spouse's parents, grandparents, great-grandparents, and so on, my spouse's brother and sister, and spouses of all of these people. This is the meaning of relative for section 56 to 10. Now, Mr. Vaibhav is the assessee. Why am I saying Mr. Vaibhav is the assessee? Because the question says we have to find what is 56 to 10 taxable income for Mr. Vaibhav. So if Mr. Vaibhav is the assessee, he is receiving the gift from whom? From his uncle. Uncle would mean what? The brother and sister of your parents. So they say that Mr. Ram and Mr. Ram and Mr. Vaibhav, they are related. How? Mr. Vaibhav is Mr. Ram's nephew. So which means if this is Mr. Ram, okay, then his brother or his sister's son is Mr. Vaibhav. So my assessee is receiving a gift from the brother of his parents, from the brother of one of his parents. This is definitely going to be a gift from a relative, hence it is going to be fully exempt. All right, so here nothing at all will be taxable. Yes, Mr. Vaibhav does receive an immovable property for inadequate consideration, but gifts that we receive from our relatives are fully exempt. And here the nephew has received a gift from his uncle. When your uncle gives you a gift, for example, if your mother's brother gives you a gift, or if your father's brother gives you a gift, that would definitely be exempt in your hands. So for Mr. Vaibhav, this gift is going to be fully exempt. All right. So what will our answer be? Our answer will be option B, nil. Nothing at all will be taxable. Right? Can we go to the next subdivision now? All right. Let's proceed to the fifth question. What shall be the total tax credit available with Mr. Ram with respect to the sale of two house properties during previous year 2021, assuming the tax was fully deducted by both the buyers at the time of payment? Mr. Ram sold two houses. He sold the Gwalior house property. He also sold the Mumbai house property, right? So when the buyer would have given consideration to Mr. Ram for these properties, what would the buyer have done? The buyer would have deducted tax, right? Do you remember the section number? Which section number are we talking about over here? I'll wait for your answer. When the buyer makes payment for an immovable property, when he pays consideration for the immovable property, there is a section under Chapter 17B of your Income Tax Act which asks the buyer to deduct tax. Which section is that? Section 194 IA, right? Section 194 IA says we don't care what the stamp duty value is. No matter what the SDV is, if the full value consideration of the property is greater than or equal to 50 lakh rupees, then when the buyer is paying consideration for the house property, the buyer is supposed to deduct tax at what percentage? The buyer is supposed to deduct tax at 1%, right? But in the COVID period, if any tax is being deducted in the period 14th May 2020 to 31st March 2021, in this period, if we are going to deduct any tax under 194 IA, then not 1%, you will have to deduct tax only at 0.75%. This is what section 194 IA says. I hope you guys remember, right? So the full value consideration is not full value consideration is 50 lakhs or above. Then the buyer, when he pays consideration to the seller, at that time he is supposed to deduct tax at the rate of 1%. But in the COVID period would refer to what? 14th May 2020 to 31st March 2021. In this period, if you are going to deduct at any tax, then you are supposed to deduct tax only at the rate of 0.75%. This is what the section says. So here they are asking us what would be the tax deducted for both the houses. Let's talk about them one by one. First of all, Gwalior house. What was the full value consideration? This property was sold for 2.10 crores. Definitely more than 50 lakhs. So definitely section 194 IA will be attracted. When did the transfer happen? The transfer happened on 15th April 2020. This is not in the COVID period. COVID period means what I told you. I told you COVID period is 14th May 2020. So this is before 14th May 2020, 15th April 2020. So you don't get the lower rate, full 1% tax will be deducted. So for the Gwalior house, so answer to subdivision 5, for the Gwalior house, 2.10 crores into 1%. So what will be your TDS? 2,10,000? Yes, entire 2,10,000 will be deducted. Now what about the Mumbai house? The Mumbai house was sold to Mr. Weber for 58 lakhs. Even this is more than 50 lakhs. So definitely section 194 IA will be attracted. But when did the sale happen? On 28 February 2021, which does fall in the COVID period of 14th May 2020 to 31st March 2021. In this COVID period, whenever we deduct tax under section 194 IA, we will deduct tax at the rate of 0.75%. So for the Mumbai house, our calculation will be something like this. 58 lakhs, which is a full value consideration, this into 0.75%. And how much does this work out to? 43,500. Right? So what is the total TDS that would have been deducted? 2,53,500. This is what your answer would be. Are we all clear with this? Yes. So total tax that would have been deducted would be 253,500. We have done this calculation as per section 194 IA. 194 IA says if the full value consideration for a immovable property is greater than or equal to 50 lakhs, then you're supposed to deduct tax at the rate of 1%. But in the COVID period, you're supposed to deduct tax at the rate of 0.75%. Here, instead of house property, tell me, had it been a rural agricultural land, would you have deducted any tax? No. Section 194 IA is not applicable to rural agricultural land. All right. So this is it with subdivision 5. Now let us mark our answer, 2,53,500, which will be option B. All right. So again, I'll wait for a minute. In case anybody is still writing, please finish it. After this, we will go to the second MCQ. I hope all of us are done. Shall we proceed? Shall we go to the second question? The second question is all about section 194O. A new question, a new section introduced by Finance Act 2020. Let's read the question. Important and interesting at the same time. TPR and Co., a partnership firm selling its product X through the digital facility provided by MKY Limited, an e-commerce operator. MKY Limited has credited in its books of accounts the account of TPR and Co. on 31st Jan 2021 by a sum of rupees 4,80,000 for the sale of product X made during the month of Jan 2021. Out of rupees 4,80,000, it made payment of rupees 4,300,000 on 3rd February 2021. Further, Mr. Pavan, who purchased product X through the facility provided by MKY Limited, has made the payment of sum of 40,000 directly to TPR and Co. on 15th Jan 2021. Which statement is correct regarding requirement of deduction of tax at source by MKY Limited? Listen to me very, very carefully. A very, very important discussion we are going to have. Important because it's a new section. This section was not there earlier. It is extremely important from your examination's perspective. Certainly, there will be at least one question in the examination. I'm talking about the July 2021 examination, either an MCQ or a proper 3 marks, 4 marks question relating to section 194O. First of all, let's talk about the section. What does section 194O say? 194O says, let's say I use an Amazon facility. Let's say question number 2. Now section 194O says, let's say I am listing my products on Amazon. Okay. So through Amazon, I am selling my product to a lot of customers. These customers, some of them may make the payment to me directly. Some of them will make the payment to Amazon and Amazon will transfer the payment to me. Section 194O says whatever amount the customers pay to Amazon on my behalf and whatever amount the customers pay to me directly, on these amounts, section 194O will be attracted. Right? Now see, if you look at the question which is given to us over here, totally 4,80,000 was the sale through MKY. Here MKY Limited, this is the, instead of Amazon, the e-commerce operator over here is MKY Limited. So sale through MKY Limited was 4,80,000. But how much money is MKY giving to my assessee? Only 4,300,000. What about the balance? The balance may be some expenses, maybe some commission. The balance may be MKY Limited's, deduction or their remuneration. We don't bother about how much commission has MKY Limited kept for itself. We don't bother about the deductions made by Amazon. Whatever amount the customers have paid to Amazon on my behalf on this amount and on this amount which I directly received from customers, on this TDS, on this tax has to be deducted under 194O by Amazon at the rate of 1%. But same thing in the COVID period, it has to be deducted at the rate of 0.75%. Now, what do I mean by COVID period? Same dates, 14th May 2020 to 31st March 2021. In this period, if the deduction is happening, deduction will happen at the rate of 0.75%. Otherwise, 1%. This is what the section says. Here, the probable place where you might get confused is, should I deduct tax at or should I deduct tax on the basis of this 4,80,000 number, or should we deduct tax on the basis of 4,300,000 number? That is why I'm saying don't bother about the deductions made by the e-commerce operator. Take the entire amount, the gross amount. Section 194O uses the word gross amount. Gross amount means before deducting the e-commerce operator's commission and expenses and all. So this 4,80,000 number is what we will consider, and this 40,000 number, which the customer directly pays to TPR and Co. These are the two amounts that we will consider. This 4,80,000 dates to 31st Jan 2021, which is in the COVID period, and 40,000 on 15th Jan 2021, even this is in the COVID period. Okay, so what is the total? The total is 4,80,000 plus 40,000. On 5,20,000, we are supposed to deduct tax at the rate of 0.75%. Who will deduct tax? The e-commerce operator. Who is my e-commerce operator? Mcqs Limited. So do the math. 5,20,000 into 0.75%. How much do you get? 3,900. So 3,900 will be the tax to be deducted under section 194O. So your correct answer will be option C. Are we all clear? Yes. So this is it with question number 2. See, section 194O talks about one more thing. It says that if the total amount, the gross amount, is not more than 5 lakhs, then no need to deduct tax. Here, gross amount number 1 is more than 5 lakhs. And number 2, this 5 lakhs point is applicable only to individual and HUF. But here, who is my assessee? TPR and Co, a partnership firm. So that is why we are not talking about that 5 lakh discussion in the solution. Okay, just in case you're wondering, I'm clarifying this. There is section 194O does say that if the gross amount is within 5 lakhs, no need to deduct any tax under 194O. But this is applicable only for individual and HUF. But my assessee over here is a partnership firm and it is more than 5 lakhs. So anyways, this point of 5 lakhs will not apply. So your answer will be option number C. All right, please finish this. In case any question, please get it clarified. Let's go to the next question. I hope you're all done. Question number 3. Mr. Harry, an Indian citizen, is a marketing consultant who provides consultancy to various countries around the globe. Due to his profession, he is required to travel across various countries throughout the year. His marketing project does not last for more than 40 days, and therefore his stay in any country, including India, never exceeds 40 days during a year. His income is 80 lakhs across the globe, which is not liable to tax in any country. During 2021, an Indian company provides him a marketing project in India. His stay in India for the project is expected to be only 25 days, and his income from that project would be 30 lakhs. Being a highly qualified professional, He consults you about the tax regime on his income and his residential status in India. This question number 3, is all about residential status. Okay. Now, residential status also, you are aware that there has been a huge bumper amendment by Finance Act 2020, where they have brought in a special provision which is applicable to Indian citizens, persons of Indian origin who are visiting India in the previous year and whose total income, excluding income from foreign sources, is more than 15 lakhs. So for them, we have a special provision. And what is that special provision? Instead of 60 days in the second basic condition, we apply 120 days. All right. So let us see whether the special provision is even applicable over here or not. Whenever you are supposed to find the residential status of an individual, you will first of all check whether the special provision is applicable. Only if the special provision is not applicable, only then you will go to the regular provision. Now, special provision, regular provision, special provision is the new provision, that 120 days provision, and the regular provision is the old one. All right. Now, if you want to apply special provision, you have to fulfill some conditions. Number 1, the assessee should be either an Indian citizen or the assessee should be a person of Indian origin. Second condition, this assessee, he should be engaged in some business or profession outside India. Third condition, in the previous year, he must be coming on a visit to India. And condition number 4, from his total income, if you exclude income from foreign sources, okay, the balance income should be more than rupees 15 lakhs. If all these 4 conditions are fulfilled, you apply the special provision. Now, does my assessee fulfill all the 4 conditions? Number 1, is he an Indian citizen or a person of Indian origin? Yes, he is an Indian citizen. Condition number 1 fulfilled. Condition number 2, is he engaged in business or profession outside India? Yes, he travels across various countries. He does marketing jobs throughout the world. So yes, he is engaged in business or profession outside India. Does he visit India in the previous year? Yes. In 2021, he is coming to India for 20 days. He is visiting India. And is his total income minus income from foreign sources more than 15 lakhs? See, they say his total income is 80 lakhs across the globe, and they say income from that Indian project is 30 lakhs. Okay, so when I say total income minus income from foreign sources, I'm basically talking about Indian income. Basically, the impact is Indian income should be more than 15 lakhs. What will his Indian income be over here? 30 lakhs. Definitely more than 15 lakhs. All 4 conditions fulfilled. So which provision are we going to apply? We will apply the special provision. Now, what does the special provision say? Basic condition 1 is as usual. Basic condition 1 says, previous year, my assessee should have stayed in India for at least 182 days. But how many days is he going to stay in India? He's coming to India for just 25 days. So basic condition 1 not fulfilled. What does basic condition 2 say? Basic condition 2 says previous year he should have stayed in India for at least 120 days. 60 days or 120 days. Special provision we apply 120 days. And for preceding previous years, he should have stayed in India for at least 365 days. Even this is definitely not fulfilled because previous year he's staying in India for just 120 days. So even this is not fulfilled. Basic condition 1 also not fulfilled. Basic condition 2 also not fulfilled. So what will we conclude? We will conclude he is a non-resident. But wait, there is another concept called deemed resident. Right? There's another concept called deemed resident introduced by Finance Act 2020. Who is a deemed resident? A deemed resident, number 1, he should be an Indian citizen. right? Number two, whether regular provision, whether special provision, whatever is applicable to him, as per that, the answer should be non-resident. Condition number three, his total income minus his income from foreign source should be more than rupees 15 lakhs. And number four, his income is not taxable in any country. Why? Because of his residential status. Do you remember learning this concept, guys? Yes, this is another Finance Act 2020 concept. Do you remember learning this? Deemed resident, all these four conditions have to be fulfilled. What are the four conditions? Number one, he should be an Indian citizen. Number two, regular provision, special provision, whatever is applicable to him, the answer should be he's a non-resident. His total income minus income from foreign sources should be more than 15 lakhs. And his income should not be taxable in any country because of his residential status. Now, are these conditions fulfilled in my question? Definitely my assessee is an Indian citizen. Special provision was applicable to him, and as per that, he is a non-resident. His total income minus income from foreign sources was 30 lakhs we discussed. Even this is fulfilled. And it is clearly given over here that his income is not liable to tax in any country. Why? Because he stays only 40 days maximum in a country. So because of his residential status, his income is not taxable in any country. All these four conditions are fulfilled. So what does he become? He becomes a deemed resident. Now let's test your memory. Let's see if you remember. Deemed resident. Where once a person becomes a deemed resident, what will his residential status be? Come on, think and tell me. Quick answer. I'm going to wait for your answer in the chat box. Quickly give me your answer. He is a deemed resident. Okay. So deemed resident, what will the residential status be of a deemed resident? A deemed resident is always considered as RNOR. Right? Deemed resident is always considered as RNOR. So even over here, my assessee will be considered to be RNOR. So look at option A. He shall be treated as RNOR and he shall be liable to pay tax on 30 lakhs. This does seem to be correct. He shall be treated as RNOR? No. He shall be treated as NR? No. He's an RNOR. We just spoke about it, deemed resident. He shall be treated as RNOR, but he will be liable to pay tax on the entire 80 lakh? Definitely no. RNOR, what is the scope of total income? Which incomes do we ask them to pay tax? We ask them to pay tax only on those incomes which are earned in India or which are received in India or incomes from businesses which are controlled in India, right? So only so out of this 80 lakhs, entire 80 lakhs, we will not ask him to pay tax. Only this 30 lakhs Indian income alone, we will ask him to pay tax. So your correct answer will be option A. He is RNOR and we will ask him to pay tax only on these 30 lakhs. Are we all clear with this? Yes? Slowly, the response in the chat box is getting lesser and lesser. Guys, be more interactive. That is how you will stay interested in the lecture. Otherwise, it will start getting boring. Please make full use of the chat box. Shall we proceed? I'll give you all a minute in case you all are taking down some running notes and something is incomplete. Please finish it and then we will resume. I hope we are done writing. Let's proceed now. Let's go to the next question. Question number 4. This is another interesting question, TDS based question again. Mr. Vyas, aged 80. He's 80 years old. Does something strike your mind? 80 and above, individual assessee, if resident, he becomes a super senior citizen. Let's assume he's a resident. So he's a retired government employee. On 1st April 2020, he received the maturity amount of his LIC policy amounting to rupees 3,50,000. So he has received money from LIC 3,50,000. This policy was taken by Mr. Vyas on 1st April 2013. So the policy is taken on or after 1st April 2012. When policy is taken on or after 1st April 2012, tell me, what is the maximum life insurance premium that we can pay? What percentage of sum assured can we pay at the maximum as premium? Policy taken before 1st April 2012, 20% premium we can pay maximum. Policy taken on or after 1st April 2012, 10% of sum assured is the maximum premium that we can pay, right? Now, sum assured was 3 lakhs. So which means how much premium he should have paid maximum? He should have paid only 10%, only 30,000. But how much has he been paying? He has been paying 40,000. All right. Then his other income comprised of pension amounting to 85,000. Mr. Vyas furnishes a declaration in Form 15H for non-deduction of tax at source to the insurance company, stating that his net tax liability for the year is nil. Choose the correct statement from below. They're talking to us about section 194DA. Let me discuss the section with you first, and then we will do the solution. So this is question number 4 that we are discussing about. Now, what does section 194DA say? Section 194DA says the tax will be deducted at source if you get money, if you get insurance compensation from any insurance company. But then not always. The section 194DA is not applicable to every. Section 194DA is not applicable in every scenario. It is applicable in only certain specified scenarios. For example, if you took the insurance policy before 1st April 2012, and if you're paying more than 20% of the sum assured as premium, then section 194DA will apply. Or if you've taken the policy on or after 1st April 2012, but if you're paying more than 10% of sum assured as premium, then again section 194DA will apply. All right. So basically, section 194DA says, section 194DA asks the insurance company to deduct tax at source when the insurance company gives you insurance compensation, but not always. Only if the insurance premium is more than the prescribed percentages, or if it is a key man insurance policy. So in only those certain specified scenarios, they are asking you to deduct tax under 194DA. Now in this scenario, in this question, if you see, my assessee has paid more than 10% premium. All right. The sum assured is 3 lakh and he's paying more than 10% premium. He's paying 40,000, which means 194DA would be applicable. But then he has given Form 15H. What is Form 15H? Form 15G and Form 15H. Through these two forms, the assessee tells the deductor of tax, please don't deduct tax. He says, as per the TDS sections, tax is deductible, but please don't deduct tax. Why? Because my total income is not more than basic exemption limit. Basically, through these two forms, the assessee is declaring that his total income is within basic exemption limit. Hence, please don't deduct tax for me. Form 15H is for senior citizens alone and Form 15G is for other assessees. Now, because your assessee over here is 80, senior citizen, super senior citizen, that is why Form 15H he has given. He is saying that his total income is not more than basic exemption limit, hence don't deduct tax. Is this clear for everybody? Is this story clear for everybody? Yes, there was some disturbance. So in case you did not understand properly, let me explain it to you once again. Section 194DA says, when the insurance company gives us insurance compensation, at that time, they will deduct tax, but not always. There are only some scenarios in which they will deduct. For example, if the insurance policy is a key man insurance policy, KMIP, they will deduct. Or if the assessee has been paying insurance compensation more than 20%, more than 10%, then they will deduct tax. The insurance company will deduct tax. So in this question, my assessee is definitely paying more than 10%. Sum assured is 3 lakhs. He is paying 40,000. Policy was taken on or after 1st April 2012. He shouldn't have paid more than 10%. But he is paying more than 10%. That is why now when the insurance company gives him 3,50,000 compensation, insurance company will want to deduct tax under 194DA. But he has given a declaration in Form 15H saying my total income is within BEL. I have no tax liability, so please don't deduct tax. Is his declaration correct? See, what will his total income be? His total income will be insurance compensation of 3,50,000, and he's also earning pension of how much? He is also earning pension of 85,000. His other income includes pension of 85,000. This from life insurance company, he got 3,50,000 and pension 85,000. Family pension, if it is family pension, he'll also be getting some exemption and all. Remember, 15,000 exemption or 1/3 of the pension received, whichever is lesser, you will get exemption. But we don't know whether this is family pension or not. For a moment, let us ignore exemption, pension exemption. Even if we ignore the pension exemption, his total income will be what? 4,35,000, which is definitely be going to be lesser than 5 lakhs. Why lesser than 5 lakhs? Why 5 lakhs? Because he is a super senior citizen. For super senior citizens, what is the basic exemption limit, guys? 5 lakhs. His total income will be this insurance compensation of 3,50,000. Why am I saying his insurance compensation is taxable? Is insurance compensation taxable, guys? It is taxable only if it is KMIP compensation, or if you have been paying more than 10%, more than 20%, only in those scenarios it is taxable. Here he is paying more than 10%, so definitely it is going to be taxable. So that is why I am including this also in his total income. So his total income is definitely going to be within the basic exemption limit. Hence, he is right. He is right in giving this declaration. The insurance company need not deduct any tax. You understood? Because his total income is within BEL, now even if the insurance company does deduct tax, will it make any sense? No, because his tax liability is 0. So even if they do deduct tax, he's only going to ask for a refund. Double work for the department. That is why he has given a declaration saying my total income is within BEL. No tax liability. He is correct. He is perfectly correct. Now see which of the statements is correct. Option A. Declaration made by Mr. Vyas is wrong. No, declaration is perfect, we concluded. Claim by Vyas is right. Insurance company is not required to deduct tax at source. This is definitely correct. Option C. Insurance company has to deduct tax under 194DA since declaration cannot be made for 194DA. No, this is wrong. Even for 194DA, declaration under 15H can be made. And the last option, declaration made by Vyas is wrong. Insurance company has to deduct tax of 1,000 under 194DA. Even this is wrong. So my correct answer over here will be option B. Is this clear for everybody? Yes, this question may be a little confusing for some of you. So those of you who are watching this lecture, in case you have any question, please make sure you let me know. All right, this should be perfectly Clear for all of you, this question, right? It's the he is right over here. My assessee is right in giving this form 15H declaration, because anyways his total income is within BEL. So no question, no point of deducting any tax under 194DA. All right, can I go to the last MCQ question now? Question number 5. A very simple question relating to set off and carry forward. Let's read the question. During assessment year 21-22, Mr. Kabir has a loss of 6 lakhs under the head IFHP. So he has 6 lakhs loss from house property. Then he has 5 lakhs loss from business or profession. And he has income of 3 lakhs from LTCG. So he has one income and two losses. He has LTCG 3 lakhs. And then he has two losses. Loss from house property 6 lakhs and loss from business or profession 5 lakhs. He filed his return of income for assessment year 21-22 on 31st December 2021. Definitely, he has filed a belated return. Do you agree with me? Definitely, he has filed a late return. See, what are your 139 due dates? Either 31st July or 31st October or 30th November. He is going and filing the return on 31st December. Definitely, this is a belated return. When you file a belated return, what impact does it have on set off and carry forward losses? You can set off losses, but you cannot carry forward losses. But there are some losses which, even though you filed the return late, you can still carry forward. What are they? Number 1, loss from house property. Even though you filed the return late, you can still carry forward the loss. Number 2, unabsorbed depreciation. Even though you filed the return late, you can still carry it forward, right? So whenever you file a belated return, it does impact your set off and carry forward of losses. Set off you can do, carry forward alone problem. Okay, so he has filed the return late and he has two losses. He has loss from house property 6 lakhs and he has PGBP loss of 5 lakhs. Now let us think, what should he do? See, if he adjusts the house property loss 6 lakhs, first of all tell me, can he adjust the entire 6 lakhs? No. He will adjust 3 lakhs. But can he adjust 3 lakhs also, loss from house property? No. Do you remember, you would have studied that inter-head adjustment for loss from house property, maximum how much? Maximum 2 lakhs. So, in this case, if I set off the loss from house property first, I will be setting off only 2 lakh loss from house property. Okay. And business loss, I will be able to set off only the balance 1 lakh. So my total income will be 0. And what are the losses that I will carry forward? I am filing a late return. So I cannot carry forward business loss. I will be able to carry forward only loss from house property. The balance 4 lakh I will carry forward. This is how your answer would be if I adjust loss from house property first. But what if I adjust my business loss first? If I adjust business loss is how much? We incurred 5 lakh business loss. So 3 lakhs I will adjust against this. Total income will be 0. What are the losses I will carry forward? Business loss I cannot carry forward because late return we filed. But loss from house property we can carry forward even though late return. So how much loss from house property I am going to carry forward? I will carry forward the entire 6 lakhs. You have two options in front of you. You think and tell me, which of the two options would you choose? Option 1, adjust loss from house property first. Option 2, adjust business loss first. How are these two options different? How is the impact of these two options different? The difference is that in my first option, Loss from house property, I will be able to adjust only maximum 2 lakh interhead. I will be able to carry forward the balance. Business loss, I actually have 3 lakhs, but I cannot carry it forward because I did not file my income tax return on time. If you look at the second option, yes, my business loss, I am adjusting first. Business loss, I'm still left with 2 lakhs, but I cannot carry that forward because late return. But loss from house property, full 6 lakhs, I will carry forward. Come on, tell me, out of these two options, which option would you pick? You would definitely pick option number 2. Why option number 2? Because here we have a bigger loss to carry forward. It will be better, right? Subsequent years, if we make a profit, we'll have more amount of set off possible. So you should be choosing option number 2. Is this clear? Yes. We see we are not just, my focus over here is not just tell you what the right answer is, close and go ahead. That will take us just 30 minutes. So many videos are there on YouTube available where in 30 minutes MCQ discussion over. No, that is not the right way. That way you're just targeting what the answer is. You need to have a proper analysis of the concept. You need to understand what if it was like this, what if it was like that. That is the right way of studying. Yes, it may take us a little extra time. We are spending a little extra time. In fact, they're spending double the time than what a lot of other videos are spending. But this way, at least our conceptual clarity is assured. Definitely, we will pick option number 2 because option number 1, we are left. See, option number 1 also 0, option number 2 also 0. Total income is same. But option number 1, we are carrying forward only 4 lakh loss. Whereas in option number 2, we will carry forward 6 lakh loss. Definitely, we should pick option number 2. Now see the answers. Which of the 4 answers would be correct? Total income nil. Okay. Loss of 4 lakh from house property. No, this is wrong. 6 lakh from house property we are going to carry forward. Total income 1 lakh. Definitely wrong. Total income nil. No loss to be carried forward. Wrong. 6 lakhs we are going to carry forward. Total income nil. Loss of 6 lakh from house property to be carried forward. This is definitely going to be right. So your correct answer will be option number B. Are we all clear with this? Yes. So this is it with your MCQs. We have had a lot of interesting discussions across these 5 MCQs. A lot of concepts were covered. A lot of good revision we had through these 5 questions. I hope all of you are clear with this. Right? So the descriptive questions we will work out in the next video. This video was just for MCQs. The descriptive questions, we will have another session today itself. All right. Maybe after dinner, post dinner at 9 p.m. shall we meet? Right. So 9 p.m. we'll work out as many descriptive questions as we can. We'll try to finish off this mock test paper today. We'll go as far in the night as we are able to, and we'll finish off. So MCQ questions I'm done. The remaining part we'll do off in the next video. All right. So I'll close this one here. I'll close this lecture here. In case anybody has any questions, please make sure you get it clarified. All right. In the chat box or WhatsApp me, wherever. So I'll close this video here. Thank you guys.